Welcome to the Main Street Money Podcast, where Wall Street meets Main Street. I'm Andrew Gay, along with Gilbert Paz and Zachary Green, and we are the Texas Hill Country Advisors, based in the beautiful Texas Hill Country here in Kerrville, Texas. And we're going to give you our latest perspective on the markets and economic data today.
You want to talk about PPI?
I'll talk about it. The core number was over 3%. So was the headline number annualized. The monthly number for PPI was, I think, 0.8%. It was hot. It was higher. Not only is that a large monthly number for an inflation reading, but it was above what was expected. So that makes it difficult for the Fed to really think about continuing smoothly with rate cuts between now and in the end of the year. They might be a little more hesitant about cutting rates with continued hotter or stickier inflation reports. We do get the jobs data next Friday. We'll get the unemployment rate, the non-farm payrolls, the number of jobs that were added, and retail sales. And so we won't get that till next Friday. But that continues to be the focal point for financial markets and the Fed, for that matter, using their dual mandate. So inflation is moderating, but it's still sticky. Mm-hmm. That's the gist.
And for those that don't know, PPI, we use the short name for it, but it's also known as the Producer Price Index, which comes out every month. It's a measure of producers and their prices and what it's doing to them. And of course, we have consumers price index. We talk about that too, but this one was for producers, and so it just indicates, I think, that still we're going to have trouble getting inflation down to the 2% mark that the Fed wants. And I still doubt seriously that the Fed's going to be able to cut interest rates anytime this year unless unemployment rate goes up substantially. And we haven't seen that yet.
Right. And the Fed doesn't really think that inflation is going to reach their 2% target until 2028. But I still think that they believe, as of today, that there will be at least one, if not two more rate cuts warranted by the end of the year.
Possibly. And I think, like I say, that the unemployment rate's going to have to go up substantially before they can justify cutting rates. Right. But I've thought that for a long time. And what did they do anyway last year? Cut rates.
Right.
They didn't take my advice, man. I put it in a white paper. I mean, I sent it to them. And come on.
But it is nice on the consumer side to see. I just saw a headline yesterday about mortgage rates falling below 6% for the first time in over 2 years, or since 2022 when the Fed started raising.
And that's a good segue into what happened in the bond market today.
Yes. And that has been, we always talk about the 10-year U.S. Treasury because it's a benchmark. The yield for the 10-year U.S. Treasury is a benchmark interest rate for a bunch of other interest rates out there in the markets, mainly the mortgage rate, the 30-year fixed mortgage rate. Those tend to kind of move together. But even though these are small moves, these are in numbers, they are big moves in terms of money. And so the 10-year U.S. Treasury yield going down, even 1.5% or whatever it is down today, is still a really, really big move because it takes a lot of money to really push that yield down there that far. Of course, money has to come into the bond market and push the face value of those bonds up for that yield to come down like that. But that's exactly what's happening. And I think it's noteworthy and something to pay attention to because it's kind of works as a resistance or floor level. And it's dropped and hit that a few times, but not blown through it and stayed below it for a substantial amount of time. And maybe this is it. Maybe this is what it took, a little bit of a risk-off sentiment in the equity markets for money to flow into the bond market and really push the yield down to stay below 4%. It's also not a one-for-one exchange between what the Fed does as far as cutting what we call the short end of the yield curve. So like the short, because that's the interest rate that they really control, is the shortest term interest rate out there. It's basically an overnight interest rate, and everything else is kind of built off of that. So regardless of what they're doing on the short end, it doesn't necessarily translate one for one in what we see in like the benchmark 10-year U.S. Treasury yield.
Mm-hmm. And of course, the 10-year Treasury hasn't been below 4% in, I think, a year and a half. It's been a while. It's been a good while.
And it didn't stay there when it was there.
That's right. That's right. It bounced back up. And this too may be temporary, but it seems to me that there's probably a lot of money flowing to the bond market that's looking for a safe haven. And that's driving down yields.
And a lot of that, I think, is due to the AI jitters that have kind of, penetrated throughout markets in the last couple of, really since the beginning of this year. I think that software has been under pressure. A lot of thought that equity valuations are stretched, especially in the tech space and the software space too, because of all the AI boom essentially that we've experienced over the last 2 years, and run-ups, historical parabolic run-ups like NVIDIA and some of those other big names that are kind of the picks and shovels, if you will, of the AI gold rush. So the thought that that those companies are kind of overvalued, and that can cause some skepticism in markets. And I think that's essentially kind of what we're seeing today with the sell-off today.
Yeah, so we had a sell-off in the equity market, bond yields dropping below 4%. We had a sticky or hot inflation number for producers. We haven't even talked about geopolitical events. There's a lot of geopolitical events out there that could also affect the market in the short term. The United States has built up a large military presence in the Middle East, close to Iran. And President Trump has talked about over the past few weeks about trying to get them to negotiate, whatever that is, for the 100th time to eliminate their nuclear program. And he's accumulated a lot of military assets there in that area to put pressure on. And if he does do something, it could cause a huge spike in oil prices and a drop in the equity markets. And then, of course, too, today, one of the other geopolitical events in that same neighborhood, Pakistan, the country of Pakistan, announced they were at total war, I think it was. That was their phrase, with their neighbor, Afghanistan. Now, do those two countries really have a lot of impact on what happens in our equity markets? Probably not. But anytime you have open conflict between two countries, that's a problem, because you have no idea how it's going to escalate, if any, and what those reverberations could be in the markets. Pakistan is a nuclear-powered country, a nuclear-armed country, I should say. And, there's not any, I don't think anybody's whispered about them actually using nuclear weapons on their neighbor, but anything could happen if you have nuclear weapons, I would imagine. So those geopolitical events are a big deal too that we have to watch in the short term.
I was going to ask if either of y'all have heard anything recent about that, because I know Maduro went out, but something has to fill that void. It can't be Trump.
Yeah, and I think part of that was Trump's desire to eliminate the head of the snake without really doing anything else. I think that was his way of influencing the rest of the people that stayed there and said, hey, listen, if you don't play ball, we'll do the same thing to you that we did to him. And look how easy it was for us to do that. So I think, a lot of the things that he's doing, at least on the international level, are about intimidating people and forcing negotiation and having leverage over them to impose his will, even without committing a huge military commitment to the country. Because, I don't think anybody, I think all the world watchers I've read about, and even in the Wall Street Journal commentaries, that we really don't want to go into that country and take it over and occupy it. We want the Venezuelans to do what's best for Venezuela. We just want them to also do what's good for the United States, which is, sounds awfully colonial. Yeah. But it's hard to argue with the fact that that country's being very mismanaged. They have a lot of mineral wealth. That's not even including their oil wealth, which could be doing so much more for the people of Venezuela. And it seems like Trump, anyway, politically, has decided that he wants full control of what happens in the Western Hemisphere. Look what he's doing with Greenland and trying to intimidate the Cubans. So there's all kinds of interesting geopolitical stuff happening.
Well, and I think some of that what stands out to me in some of that is the fact that maybe by design, the administration has taken kind of a strong arm to dealing with some of that. And I don't know, I think just from a nonpartisan perspective, I really think that maybe there's something in that other countries pick up on, and maybe they are more timid, or maybe it does deter them from doing taking certain military action or something that they otherwise would, because they realized that all of a sudden, maybe their perception was that there were decades of just words and tough talk from the U.S., but now someone's in the White House is crazy enough to act on some of that stuff. And I don't know, maybe, I'm not saying that's a good or bad thing, but it's definitely not something that has been typical over the last couple of decades. It's not, basically, I would say since the early 2000s, after 9/11, that was the last kind of militaristic action that we took that was that strong, I think, that really stood out like that. And everything else since then has just kind of been, has not measured up to that level of escalation, I don't think, up until now. It feels like it's kind of there now.
Yeah, one thing's for sure, Trump has all world leaders scratching their heads thinking, what is this guy doing?
And maybe that's what he wants.
And it very well could be. And I think he's decided a long time ago that America first is his main priority, and he doesn't care who you are. He's going to rattle your cage if he thinks it's in our best interest. Now, whether it is or isn't long term, I don't know. I think all those things remain to be seen, but he's certainly got everybody thinking. And I think probably the name Trump is in everybody's lips at least once a day, thinking, what is this guy doing?
Yeah. And once again, it's like, it makes you wonder if that's part of the plan.
Yeah.
Like
yes.
That's part by design.
And we have to recognize that no matter what happens, whether it's good, bad, or indifferent, some of the things that he chooses to do will have an impact on us, all of us, as citizens of this country, taxpayers, investors, and the impacts might be small, they might be big, but they're going to be long lasting, I think, in many ways, especially when it comes to foreign policy, tax policy, domestic policy, heck, immigration, any of those things that you want to throw out there. Who is in the White House matters. And us as taxpayers and investors should pay attention to that.
We look at personal finance, personal financial pictures, and try to help people help guide people in the best course of action.
No matter who's in that White House.
Yeah, right. Because that will definitely change. It always does, and it always will. Markets always go through cycles. But having a disciplined approach to your financial picture and your financial future, we think is the best course to take. Now, how that is made up or constructed, that's what we're for, is to help you construct the actual plan.
Yeah, we're not, I don't think anybody should be waiting for the politicians in Washington, D.C. or Austin, Texas to quote unquote fix us financially or make us successful or not successful. But does what they do matter? Sure, it does. But I think what matters more, as you pointed out, is what are you doing for yourself?
Right.
That's the key. And us as financial advisors, we can give you the tools and tricks to manage your personal finances a little better, so that no matter who's over there, you can weather that storm and be successful long term.
One other thing I wanted to mention, because I did not yet, but with the sell-off or the risk-off action we had today in the stock markets, that sent the S&P and NASDAQ in negative territory for the year, with the NASDAQ being the leader there. I think it will be down after the week's said and done, more than 2% on the year.
Yes,
so
for sure.
Only took us 2 months of 2026 before we really got into negative territory. And I feel like there was a piece put out by Capital Group a month or two ago for their 2026 outlook. And one of the main things they mentioned was a down market this year would not be surprising. I think a lot of us have mentioned this so many times, but there's only been 4 instances of the S&P 500 in the last 75 years having 10% plus positive gains for 3 years in a row. So that's, there's only 4 of those in the last 75 years. And the 4th year out of all 4 of those outcomes was a mixed bag. 2 positive years, 2 negative years. So I think it's with the uncertainty around what's going to happen with interest rates, how fast is inflation moderating, what's going to happen to the job market, are we going to see unemployment tick up, are we not? And then, of course, the AI fears that are out there. There's just more uncertainty out there than there usually is in financial markets, which is,
I think uncertainty and volatility are the keywords for the year.
Yeah, which makes it even more pertinent why you should choose right now to come talk to a financial advisor about your plan and your strategy. And if you don't have one, we can help you create one. That's what we're here for. Okay, with that, I think we'll leave you guys for the weekend. We'll be back next week, and have a good week. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.